The tax office has one rule and is that it has to be fair and reasonable. If our estimate is fair and reasonable, same thing as quantity surveying tax depreciation work, as long as the estimates that are come up with are fair and reasonable and has logic, then that will stand.
Most people, when they buy a property, the bank will assign a valuer to give a rough estimate of what the property is. I guess from the bank's perspective, they want to make sure that they're not lending out too much money to control their risk.
With property valuation, there's always that underlying risk. They've got some interest in that property, and so making sure the value is right where it needs to be. So that's the reason why a mortgage valuation is always in place when you are purchasing with a loan.
The ATO doesn't want a range. The ATO wants a number.
If you know you're going to sell the property, the best time to get a report done is now.
Hi everyone, welcome to another episode of the Investing for Doctors podcast. I'm your host, Dr. B. And today we have Tuan back from Duong Tax again. Tuan, great to meet you again.
Yes, good to see you.
So today we're going to talk about a little bit about valuation, which is another service that your business does. Before we start, give us a quick brief about you and what Duong Tax does.
Yes, so Duong Tax are quantity surveyors, but also property valuers. We've had this arm in our business 4 years out of the 10. It stemmed out of the need and necessity from our partners and very hand-in-hand type services when it comes to this, because we're obviously assessing properties, one for construction value, and in this case, we're looking at land and building value. And so it's they're very similar services, but something that we thought we could dig our teeth into. So property valuation.
Yeah, because like the depreciation is a value from a tax perspective, and valuation is for other reasons. So what are some of the reasons why you would want to get a valuation? I mean, I think most people, when they buy a property, the bank will assign a valuer to give a rough estimate of what the property is. I guess from the bank's perspective, they want to make sure that they're not lending out too much money to control their risk. What other situations would you need to value a property?
Yeah, and of course with property valuation is there's always that underlying risk for a bank, especially when they're lending. They've got, of course, they've got some interest in that property, and so making sure the value is right where it needs to be to ensure they're protected in case that the property has to sell due to unfortunate circumstances or whatever reasons. So that's the reason why a mortgage valuation is always in place when you are purchasing with a loan. The other things that we do when it comes to property valuation, Duong Tax doesn't dabble too much in mortgage valuation as it stands at the moment, but we spend a lot of time with our partners, especially the professional services, financial services sector, accountants, solicitors and whatnot, and so we're dealing with things like stamp duty transfers. So if you, mum is selling a property to her daughter, and it's sort of like for $1, of course, that would be subject to
capital gains tax and stamp duties,
a transfer fee, which is called stamp duty in New South Wales. And so the ATO or the Office of State Revenue or Revenue New South Wales now would want to know what is the fair market value in order to pay stamp duty on it. Even though it's a family transfer, they would expect that. And so a registered property valuer needs to assess that property and assess whether, what that looks like. And then of course that 3% stamp or whatever it is at the present time for that present state, because it's a state-based tax, is applied to that transfer value that the registered property valuer comes up with.
Okay, so for for transfer valuation, all right. What other examples?
The other most common one that we've come across is capital gains tax valuation. And that's essentially the valuation for when we are switching properties in the use case, in which case is owner-occupied usage to investment usage, or investment usage to owner-occupied usage. In that
owner-occupied
doesn't get slapped with any you
get an exemption
you get an exemption on capital gains tax. But of course, if you're switching the usage, the exemption goes away and you are now liable for capital gains tax. But the liability on capital gains tax only is applied on the sale of the property once you decide to move that property on. So that means that people would want to, or investors or owner occupiers, they would need to get a valuation from that said date. So even if you're getting a report done at a much later date, and for example, if you decided to, like you did, I think it was 2016 that you decided to move out of the property. So there would be a CGT event in 2016, which means that if you go to sell the property in 2025, for example, we would need to do a retrospective capital gains tax valuation on that property from 2016.
Okay.
And that can be done with, of course, a lot of research. But of course, if you know you're going to sell the property, the best time to get a report done is now. At the time of switching that property from owner-occupied or investment owner-occupied, because of, a lot of evidence being available in that market. And then you could argue, I guess, that, hey, I believe my property is worth less. When it's favorable to most investors, everyone wants to obviously save tax where they can. So the best time to argue these points is when you are actually doing the work, and that you're saying, okay, well, I want to get a report because I'm going to switch my property now, and I believe that it's worth more at 1.2 mil or whatever it might be to the valuer, and it's a discussion then.
Okay.
But it's very hard to do so at a later set date.
Yeah. So let's just give it an example for so people can put some numbers to their head. So for instance, I initially bought this place at $500,000. Lived in it for a couple of years, and thankfully, when the time I moved out, it's now worth $600,000, say fair market value, right? And I want to get the valuation there and lock in that $600,000 because now my cost basis is not 500 but 600 if I sell at any point in time in the future. The question is that if I say sold much later on, and I know I'm not holding you to this because you're not an accountant. What are the different ways of calculating? Do you always have to get a valuation, or can you say, oh, look, I've lived in it for 5 years. I've now it's an investment property for 5 years. So pro rata, half of the capital gains should be exempt, or do I have to get a valuation?
It's always the ATO is very strict on this, in that the valuation has to be at the said date of when that change in use occurred, which means the owner occupied to investment, and it has to be from that date. It cannot be prorated and spread evenly. And as you know, that from 2015 to 2018, it was a great market, and 2018 to 2021, it didn't do much, and 2021 to 2025 now, it's been quite stagnant as well. So it's been quite aggressive up until the last couple of years without the rate change. So there is this economic cycle in which spreading that cost out is probably, it can be fair or unfair on the investor or on the
so
taxpayer.
They don't give you they don't give you the option. You have to get a valuation.
That's from my understanding as we're property valuers. We only get requested to provide valuation at said date, which is, I believe, what most people do. And the option to pro rata, it's something you have to ask an accountant. But I don't believe, not that I can give advice, I don't believe you can do that.
Okay.
But something to be cautious of.
Yeah, beautiful.
Yeah, and best time is to do it is the time you decide to change the use.
Yes, absolutely. And so, for instance, if I just completely ignored it and I've left it going for a long time, how do you then calculate? Do you just look at market trends and what the valuation would have been at that point in time, or I mean, how do you do this valuation?
So the valuation team in our office any valuer would have to come up with I guess a set of metrics in that we'll come up with some properties that was purchased around that time, so we can do a market assessment based on, okay, these are the comparables for that period. As close as we can get those comparables would then summate, okay, well, this is the value of the property based on these averages of these properties, whether a property is inferior, superior, whatnot, in terms of size, land size, building size, finishes. And that's very a subjective matter when it comes to the property valuation estimate.
Yeah, so I mean, it is quite subjective, right? And obviously, if there's more data or more like for like properties, you get a better estimation of the actual value.
Correct.
But depending on what kind of property it is, that might not always be easy.
Commercials are very tricky to do because they're not always marked as a sale price. So there needs to be research that goes into it. Rent comparables and things like that are not easy to come by for commercial versus residential. If you go into a rural property, how many of those in that area. And so coming up with that can be quite unique, and the person that always knows the best is always the property owner, and that has a lot of subjectivity as well. But it does add a lot of value into the report, because it means that people local, or you locally, know what your area is worth. And so it's a case of, yes, a property valuer needs to be independent in its advice, but that has to come from various sources like local agents, local people living locally or have sold locally. They would be the best people to dictate what type of property values a property is worth.
Okay. And so because it's a subjective thing, and there'll be a range and I guess a confidence interval of that.
Yes.
Right? How flexible are you, can you go in that confidence interval? Because at the end of the day, the ATO doesn't want a range. The ATO wants a number.
That's right.
Right? So I know this might be a tricky question to ask.
But yes, it's a great question. And the best answer I have is the tax office has one rule, and is that it has to be fair and reasonable. If our estimate is fair and reasonable, same thing as quantity surveying tax depreciation work, as long as the estimates that are come up with are fair and reasonable and has logic, then that will stand.
So you could, there's a range, you could play on the higher end or lower end.
Correct.
Depending on some more subjectivity, and just say, well, that's that.
That's right. And of course, what with the number we come up with might not always be right on the money, but that's where the communication with all these partners or parties can give us a much more indicative value. And it's through these communications that allow us to substantiate our fair and reasonable estimate.
I'm going to read between the lines there. All right. So in those situations where you switch between a use case to another use case for calculation of capital gains, that's another good time to get a valuation report. So now we covered 2 use cases. What are some of the other?
And we've had
ones?
We've had some cases, of course, in the legal world is of course solicitors and whatnot. They've got clients that, of course, separations, valuations that are required there, especially when you're trying to split assets. Part of that. And so there are other scenarios that we unfortunately
I can imagine in those situations where I'm keeping the house. And one person wants that to be as low as possible, and someone else, the other person that's leaving probably wants that to be as high as possible, because then that contributes to the asset pool.
And then of course those can also go to court, in which case, termination or going up on stand to be assessed. Of course, that is another type of work that we do, but. Not so much on the court side, but certainly with, sort of trying to settle outside of court, we do help. And of course, when people are in businesses and they want to split the assets because the business is, either winding down or, being merger and whatnot, the assessment needs to be made on the valuation of the building.
Of the assets that the business owns.
Similar purposes. And so we do that as well.
Okay. Clearly, in maybe inheritance as well, that also comes in, because
like for
things and
correct, evenly. and there might be CGT events there if there's sales, but most of the time it's a stamp duty transfer. If it's part of a trust that's being sort of broken into separate. But also one of the things we're doing is SMSF valuations. That's very common these days. We've started doing more of it, and we've had to really adjust the product, because obviously, of course, the product has no intrinsic value until you hit preservation age, in which the ATO really wants to know, what the assets are worth inside that pool. And so an SMSF valuation used to be able to be done by your local agent, or the property manager looking after your property would have a real estate arm, and they give you an estimate and a rental estimate, so you could lodge it part of your SMSF audit. But now that's becoming less of a case, where a real estate agent, ATO is really pushing for a registered property valuer to actually assess it. And of course, not everybody wants to pay top dollar when there's no intrinsic value on a report that is all for audit. And so we do offer these reports now. I think it's like we're charging very minimal, $250 plus for a resi, and then $550 for a commercial. It just means that it gives our clients a bit of peace of mind to say, hey, here's a a report that I can lodge with my SMSF audit. To ensure that
because it's a continuous process,
correct?
Right? It's ongoing business, and with each time, you're not really you have to go in again and keep looking at it.
That's right.
Yeah, unless they've done any changes to it.
Exactly right.
Yeah, that's interesting.
And of course, I don't understand completely because I haven't, of course, crossed that path in my life. But there needs to be a certain value that is ascertained by the self-managed super fund in terms of the asset value. So of course, believe there's thresholds that.
Yes, because look, they're talking about doing sort of unrealized gains, right? So there'll be a lot of that if that happens.
That's right, and it's becoming more frequent than ever when it comes to SMSF investing, especially in this day and age when people are falling short of funds at a personal level to borrow. SMSF offers that advantage in that there's funds there available that people haven't tapped into for years. And so now there's an opportunity here the leverage is available. Let's go and leverage and borrow money against it to buy property. So now it becomes more of a use, I guess, more prominent in the the investing space because people aren't buying in their personal names as often as they used to be. Perhaps.
Hi, I'm just going to interrupt this episode for a brief moment. If you've been enjoying this episode and just realized that you could be saving up to thousands of dollars with a depreciation report or a valuation report, we've got a deal for you. We've managed to secure a $100 discount on both of the services that DualTax runs. And if you would like to take advantage of this special deal, you can access this deal via the link below in the show notes or visit ifdgroup.com.au/DualTax. That's DUOTAX. And now back to the show. So one of the things you mentioned earlier is that you guys are private sort of valuers, so you don't typically do the brokerage or mortgage brokering. Is there any situation where I can say the bank's valuer gives a particular value and I do not agree with that value and then get my own to substantiate? I mean, I'm sure the bank would just say, no, we're using ours. But is there any situation where you utilize that service? Personally, I don't know because we're not in the mortgagee valuation space. I have personally got a second opinion before. In a commercial setting, you pay for the valuation, so it can be expensive. But in a private set and in a residential setting, you could actually get a second opinion through that bank, or go to another bank and ask for that second opinion. So it's great that there are those options in the property valuation spaces that you don't have to rely on that person's valuation, particularly when it's not favorable for you and you feel that it's inadequate. And residential is a lot more flexible like that because you're not paying for the property valuation report. Yes, especially with the banks.
Especially with the banks.
So, okay, so in that situation, there's really not much point in getting a private valuer to come in and fight the banks.
Only on a land tax objection.
Oh, okay, so you're fighting the government and not the banks.
Yeah, correct. In a land tax objection.
What happens then?
We don't do a lot of this work. What I understand is that a land tax, obviously valuation, if you're not happy with it, you have the right, if you flip the page over, you have the right to object.
There's on the other side
your
the
private,
objection.
private valuer to do the work and submit that part of the objection and see if you can. Most of the case of my personal experience is that from what I've heard is that not easy to come by an objection with the
state revenue office.
But it's something if you feel that you're entitled to, why not? Of course, it comes at your own cost.
Yes,
organizing your private property valuer. But it is possible to object.
Any other sort of situations where you find people are using sort of valuation services?
Not outside of that, not really. In our short 4 years, we haven't had to experience much outside of the property valuation for stamp duty, capital gains tax, land tax objection, and of course in court, which is something seldom we do. And of course you've got your mortgage valuation. So outside of that, not really.
Okay. So ever been pulled up on court yet? Or
no, we do get asked the odd question from especially ATO for tax depreciation work, as well as stamp duty from state government. But it's only really for a case of a check to make sure that we've got the methodology in which we substantiate the work, and which is very important for any valuer. And substantiation is everything. It comes down to that. As long as you can substantiate it and it's fair and reasonable, then the ATO, Office of State Revenue, New South Wales, they're very happy with it.
Okay. There was something that you mentioned at the very start. So you can also provide sort of valuation for construction, for instance.
Yeah.
So you're going out to build something. You have your architect has done this beautiful work of drafting their grand vision.
Yeah.
And then you submit it to the builder, and the builder said this is going to cost all of these things. Is that something that you guys also do in terms of the valuation?
That's more on the quantity survey side. But
exactly.
Like I was saying to you, that side of the puzzle is that if you go and build something grand and you're an owner builder, as a perfect example, and then it's cost you $1 million, but you go to sell that property, or you go to whatever it is, and you have a tax liability on the property on the sale, and you can't substantiate that $1 million, that's where it's really worthwhile to get an accountant on board. And get a quantity surveyor on board after the appointment from the accountant. Get the quantity surveyor to substantiate that build and make sure it's worth $1 million. Because if the ATO says, I'm not going to give you that $1 million, I'm only going to give you $500,000 or whatever it might be, where you feel that you're shortchanged and you're paying a hefty CGT bill, well, a quantity surveyor can help you reduce that, alleviate that capital gains tax liability. So that's more of a quantity surveying construction cost analysis to reduce your CGT liability. Another way to save tax for sure, and all in the same realm.
Yeah, it's
but
very adjacent to each other.
It is very adjacent to each other, and there are benefits of just asking the question. When you get a CGT bill or any type of tax bill that's related to property sale, it's worthwhile asking the question to the accountant at least.
So from a technicality perspective, what is the actual difference between valuer and a quantity surveyor? Because you're both putting values on things, aren't you?
That's right. And I guess the easiest way to put it is, a quantity surveyor puts aside everything to do with land and everything to do with the construction of that property. The construction of that building can come down to how ease of access on a property can throw out the construction cost big time. Traffic control, getting trucks in, how often you can get a truck in to deliver materials.
Also, even the construction phase of that
it will dictate the costs.
We
can go into construction sites of I looked at a building here in Paddington. One laneway access. And no parking. Because it's a school zone. And so there was limited access between, I think it was 9:30 to 3 o'clock or whatever it was. And which means that it really affects, and that construction program was something like 2.5 years, which something was only meant to be 18 months. Because of the lack of access and the ability to get into the property. So those are the things that a quantity surveyor looks at. But when it comes to property valuation, yes, understanding the cost of the building is important because that contributes to the value of the property. But more importantly is understanding what type of property and where's the uplift on this property? Where's the nearest schools, parks? Recreational facilities, all these things add up. How close is it to the corner? Is it on the corner? Is it not? Has it got views? All these things that contribute to the value of that land.
So as is right now today. Whereas
is there a DA on it? Is there no DA? Looking into these type of things can really impact the value of a property. Is that something a property value will do?
Right. So the quantity surveyor looks at all the construction and those side of things and puts a price tag on, I guess, some of the non-physical elements of it. Whereas the valuer is just like, okay, this is what we have here today. What is all this worth?
That's
and
right.
And it includes the land as well. Obviously.
And of course, essentially almost the goodwill of a property is what the property valuer is looking at. Where are all those intangible things that you can have that really brings up the property value? Because that's the end of the day, that's what it's really worth, right?
So before we finish off, I just wanted to ask some special case scenarios, right? Apartments are probably easy to value, but things like freestanding houses in prime suburbs, which those McMansions, Those are very hard to value, aren't they?
They are, because it comes down to aspects, views, construction costs, and knowing construction costs from a value is very tricky to do. So that's something that we've got to do a lot of investigative work, especially building contracts, and that's not always easy to find, especially when they're not the builder. They haven't built the property themselves. And so that has some challenges for sure.
But they have huge implications if they're off by $1 million, $2 million, right?
Correct,
it's like huge amounts.
Yeah,
all right.
Correct.
Okay, so look, thank you so much for giving us that insight into the valuation and the differences between a quantity surveyor
and property valuer.
Exactly. I'm sure we have more things to talk about in the future.
Maybe another episode.
And I really want to explore the commercial side, because we've been mostly talking about residential. So great to have you on the show, and we look forward to seeing you again.
Yeah, likewise. Thank you, B.
All right.
Cheers.
This podcast is for educational and entertainment purposes only. The information and opinions shared are not intended as personal financial advice. The content presented should not be relied upon for making financial, investment, or other decisions. Listeners are strongly encouraged to seek the advice of qualified financial or legal professionals before making any financial decisions. While we aim to provide valuable and accurate information, we make no guarantees regarding the completeness or accuracy of the content. Any reliance on the information provided is done at your own risk.